Okay, you want to buy a bank. Somewhere in the building you're about to own, there's a vault. It's mostly for show. The real asset isn't behind that door. It's one clause buried in a federal charter, granting you a power the rest of us would go to prison for. The right to create money that didn't exist 5 minutes ago. Ashford National Bank. 4 branches, $350 million in assets. A name nobody outside its own zip code has heard of yet. Is now yours. Nobody mentioned what the government charges for a power like that.
Chapter 1. What did you actually buy? Before you touch a single customer's dollar, the FDIC wants proof you can survive without one. It's the only industry where the surest way to get permission to handle other people's money is to prove on paper that you don't actually need it. The baseline is $20 million in your own capital, sometimes more in a competitive market, plus roughly $200,000 in legal fees and another $300,000 in consultants, just to assemble the paperwork. That paperwork becomes a banking charter, 800 to 1,500 pages, essentially a novel-length autobiography for a bank that hasn't opened yet, written entirely in the future tense. Regulators then spend 18 to 24 months deciding whether they believe it. There's a faster door in, and it's usually the smarter one. In January 2025, Plumas Bancorp agreed to buy Cornerstone Community Bank, a lender with roughly $658 million in assets, for $64.6 million. Community banks generally sell for 1 to 1.5 times what they're worth on paper, which puts a $250 to $300 million bank at around $40 million. Pay that, and you inherit customers, branches, trained staff, and a license someone else already earned. No 18-month wait, no autobiography to draft. Either route ends the same way. You're now holding one of the most valuable pieces of paper in American finance. Not permission to open a business, permission to take deposits and turn them into loans that earn you money before they're ever repaid.
Chapter 2. Where does the money actually come from? Picture a customer handing over $1,000. You'd assume it sits somewhere, waiting for them to ask it for it back. It doesn't have to, and increasingly, it doesn't. In March 2020, the Federal Reserve quietly cut the reserve requirement to 0, the old rule that forced banks to physically hold a slice of every deposit in reserve. That number now applies to every bank in the country. So when a customer down the street asks Ashford for a $200,000 mortgage, nobody goes looking for cash sitting idle to fund it. The bank simply types $200,000 into his account, and the number appears out of absolutely nowhere. The same trick a counterfeiter goes to prison for, except here it comes with a charter and a plaque in the lobby. Banks don't just store deposits. Inside their capital and regulatory limits, they're licensed to create money, one loan at a time, and it vanishes just as fast the moment the loan gets repaid. Here's what that's actually worth to you. Keep $10,000 in savings, and Ashford pays roughly 0.5%, $50 a year. Lend that same $10,000 to someone else buying a house at 7%, and the borrower hands over $700 a year. The depositor got $50. You keep $650 on money you never had to find yourself. That spread has a name, net interest margin, and for a small bank, it typically runs 3.5% to 4%. For JP Morgan, with roughly $4 trillion on its books, that same spread alone brings in close to $95 billion a year. Your deposit was never really sitting anywhere. It was already out becoming somebody else's mortgage, earning you a fee for having briefly touched your account before it left the building.
Chapter 3. The second business hiding inside the bank. Lending at 7% is the polite version of this business. There's a second one running underneath it, and it has considerably worse manners. Americans currently carry $1.25 trillion in credit card debt, at an average interest rate around 21%, more than 5 times what the Fed itself charges banks to borrow overnight, which is a strange arrangement for the one entity in this story that actually needs the money least. Watch what that does to an ordinary balance. A customer carrying $5,000 on a card gets told the minimum payment is about $100 a month. Sounds manageable, almost responsible. Of that $100, roughly $90 evaporates into interest before it touches the balance at all, leaving $10 doing the actual work. Keep making minimums at that rate, and the original $5,000 is still around in a decade. having generated close to $7,000 in interest along the way. A second invisible loan nobody applied for, made entirely out of patience. None of this works if people pay their balance in full, so it's convenient that most don't. Roughly half of all American cardholders carry a balance from one cycle to the next, and every month it sits there, it keeps paying you. A mortgage takes years to show you a problem. A card book pays out weekly, recession or not.
Chapter 4. The fee Congress just brought back. There's a third machine inside the bank, and it runs on a number small enough that almost nobody fights it: the overdraft fee. Spend a few dollars more than what's sitting in a checking account, and Ashford can cover the gap and charge roughly $35 for the favor, a fee that has nothing to do with lending anyone real money and everything to do with timing. In December 2024, regulators tried to shut this down. The CFPB finalized a rule capping overdraft fees at $5 for larger banks, set to take effect in October 2025. Banks and credit unions fought it, and in the spring of 2025, Congress overturned the rule entirely. The Senate by 4 votes, the House by 6, and the President signed the repeal into law that May. The $5 cap never took effect. It's not just dead. The repeal legally blocks regulators from trying anything similar again, without new authorization from Congress itself. The fee never really came back, because it never actually left. By 2025, banks and credit unions were collecting more than $12 billion a year from overdraft and related fees. JP Morgan and Wells Fargo alone, roughly $1 billion each. And the fee doesn't fall evenly. Roughly 9% of accounts generate close to 4/5 of all that revenue. The same customers, overdrafting again and again, effectively subsidizing free checking for everyone else in the building. None of these machines, on their own, can actually kill a bank. What can is much simpler, and it took exactly 1 weekend to prove it.
Chapter 5. What can kill a bank in 44 hours? On March 8, 2023, Silicon Valley Bank, the 16th largest bank in the country, roughly $210 billion in assets, told the market it had to raise emergency capital. Regulators shut it down on March 10th. 44 hours for one of the largest banks in American history to go from fine to gone, which is roughly the time it takes most people to assemble a piece of flat-pack furniture. Around half of America's venture-backed startups banked there. And the moment trouble started circulating through founder group chats, depositors pulled money out together from their phones, with no teller line to slow anyone down. $42 billion left in a single day. What the bank actually held in cash was a fraction of that. The rest was parked in long-term government bonds, bought with short-term deposits, bonds that had quietly lost value the moment interest rates rose, forcing a fire sale the second everyone wanted their money back at once. The real failure wasn't the bank one itself. It was everything that made the run so fast. Roughly 89% of SVB's deposits came from one tightly connected industry that all found out within hours of each other. The mismatch between what it owed today and what it had locked away for decades had been sitting there the whole time, waiting for someone to notice.
Final question. So what did you actually buy? Run 2 versions forward. Stay small, and the first 3 years lose money. Nearly every new bank's do. By year 5, Ashford is holding roughly $350 million in assets, earning close to $13 million a year in net interest, plus a couple million more in fees. After staff, branches, and the compliance costs that never take a year off, you keep around $4 million a year. 10 years in, sell to a regional buyer, and you likely walk away with roughly 4 times what you put in. Go regional instead. $18 to $28 billion in assets, hundreds of branches. And the same mechanics scale into $650 million to $950 million a year in net interest alone, with several hundred million more arriving through cards, fees, and overdrafts. Net profit lands somewhere near $400 million a year. Go back to that vault from the beginning. It was never holding the money. The money was already gone the moment the bank opened for business. Out as somebody's mortgage, somebody's card balance, somebody's overdraft. Each one paying you a little on its way past. You didn't buy a building full of cash. You bought the license to keep other people's money in constant motion and charge them for every second it isn't sitting still.
If you enjoy discovering the hidden economics behind everyday businesses, subscribe. We'll see you in the next one.